The Justice Department is now probing valuations at a BlackRock private credit fund, and that single sentence should stop every single investor cold. Not because BlackRock is going to disappear tomorrow, it is definitely not going to disappear. And a DOJ probe does not mean BlackRock has done something criminally wrong. Nothing has been proven in a court of law yet. However, the biggest problem in the entire private credit industry is exactly what they are probing right now. Valuations. There have been massive, glaring questions about valuations for years. And this government investigation just took everything up a whole notch or 10. The question everyone needs to ask themselves right now is how much are all these private loans actually worth? And who exactly gets to decide that number? What happens when investors and banks and regulators and now possibly federal prosecutors stop taking those asset marks on pure faith? That is the real story here. Not just one single BlackRock fund, not one Blue Owl share buyback, not one Carlyle dividend cut, not one so-called problem fund at KKR or Apollo. The real story is that the massive private credit cycle is moving deeper into the dark part, where trust really starts breaking down. And once the core issue becomes trust, the problem is no longer just about standard credit losses. It rapidly becomes a problem about funding, it becomes a problem about collateral, it becomes a problem about massive investor withdrawals, it becomes banks pulling back their leverage, and insurance companies rapidly reassessing their entire financial exposure. In other words, it becomes a full-blown credit crunch. And we have got yet another cluster of stories on the private credit bus, which all point in the exact same direction toward escalation. So we have got the DOJ probing BlackRock, we have got troubled funds at Apollo and KKR. We have got Carlyle SBDC cutting its dividend, and of course, it could not be a single day that goes by without another sketchy story about Blue Owl. This time, their management is buying back $85 million in shares. This is a clear, undeniable pattern. It is a textbook pattern of what stage 2 of a financial meltdown actually looks like. Now, the reason the BlackRock story matters so much to your wallet is because private credit depends entirely on a simple, seductive promise. And that promise is, hey, don't worry about daily market prices. These private loans don't trade every single second. Like stocks on Wall Street. They don't have the same constant price discovery as U.S. Treasuries or corporate bonds or leveraged loans, and that lack of daily pricing is supposed to be a feature, not a bug. Private credit managers love to tell wealthy investors that because these assets are completely private and because they are held to maturity, they are not being constantly repriced by panicky emotional markets. So investors can magically earn stable, high returns without all the sickening volatility, and during the massive upswing of the economic cycle, that pitch sounds absolutely fantastic. High yields with low volatility and limited defaults, even some great diversification driven by direct relationships with corporate borrowers, senior secured loans that are held to better covenants and less mark-to-market noise. That was the glamorous marketing pitch that sucked in billions. But the dark, hidden side of having less mark-to-market noise is precisely this. If there is no active public market price for an asset, the fund manager has to model the value themselves. They literally get to grade their own homework. And once economic stress begins to rise in the real economy, that valuation model becomes an entire game of deception. Because if the internal model says the loan is worth 98 cents on the dollar, the fund's net asset value looks totally fine. But if the actual market would only pay 80 cents for that exact same loan, that is a completely different, terrifying story. And if the big commercial banks lending leverage against those private assets start thinking the real number is also 80 cents. While the private fund is still stubbornly saying 98 cents, that instantly becomes a catastrophic funding problem. And if retail investors suspect the real number is 80 cents, while the fund desperately insists it is 98 cents, that becomes a massive redemption problem where everyone runs for the exit at once. And if government regulators think the real number is 80 cents, while the fund still claims 98 cents, that then becomes a massive oversight problem. And if the United States Department of Justice is actively asking criminal questions about valuations, it is already becoming something else entirely. Again, no wrongdoing has been legally proven yet. I am not saying there was blatant fraud, though. God knows there has been plenty of fraud in the past financial crises. I am saying that this is the precise systemic fault line that independent critics have been warning about for years. One of private credit's greatest key weaknesses is its total opacity, its complete lack of transparency. And the reason that opacity is a lethal weakness is simply because of what I call bubble behavior, garbage lending, which creates the massive potential for serious unrecognized losses. And now that historic opacity is really being tested as we get even more signs pointing to, and only ever pointing to, more systemic trouble, always in that same direction toward escalation. Now, what Bloomberg recently reported regarding BlackRock was that the Department of Justice may be investigating valuations and specific valuation techniques at the exact same BlackRock fund that we have been talking about for at least a couple of months now. And this is a major earth-shaking development, not because BlackRock is some small fringe player on the edge of Wall Street. It is exactly the opposite. BlackRock is the absolute biggest asset manager in the entire world, managing over $10 trillion. It is as mainstream finance can can possibly get. And that institutional stature is what makes this investigation so incredibly important. For the last year or so, private credit defenders tried to explain every single problem away as just some isolated, unfortunate case. They would see one bankrupt borrower and say it is completely isolated. They would see one bad loan and call it a total one-off. They would see a business development company trading at a huge discount and blame it on over-emotional, stupid retail investors. They would see one fund gating its withdrawals and claim that is not representative of the entire multi-trillion-dollar industry. They would see a reckless lender using too much payment-in-kind interest, and they would tell you that is just normal industry practice. But once the contagion and concern reaches a flagship BlackRock fund, that comforting isolated case argument gets a lot harder to maintain. Listen to me, that does not mean BlackRock did anything illegal. It means the foundational valuation question has officially moved from independent critics and short sellers and skeptical investors straight into the regulatory and potential law enforcement spotlight. And that matters immensely. I am going to say it again, because valuations are not just some boring, dry accounting matter for nerds. Valuations are the absolute foundation for everything else that follows in the financial world. They single-handedly determine reported performance numbers, and they determine the massive management fees these Wall Street billionaires collect. They are the sole reason why investors feel comfortable staying inside the fund, and they are how new capital comes in, either from massive pension funds or from yield-hungry commercial banks. In the private credit world, the mark is the entire story, and the entire multi-year private credit boom was built on the shaky idea that those internal marks were reliable enough to trust. So the urgent question now is not what if investors stop trusting them. The real question is how far has this systemic mistrust already gone, to the point that it could soon see the inside of a federal courtroom. And remember, as I talked about in detail last week, this is definitely not the only legal drama surrounding this massive private credit bubble. Blue Owl is currently being sued by a major investor who is alleging the exact same systemic thing, bogus valuations. When I was 22, back in 2021, I was working a soul-crushing corporate finance job making $45,000 a year. I remember looking at my bank account, seeing exactly $1,245 left after paying rent, and realizing the mainstream financial advice was a complete lie. They tell you to save your pennies, skip your daily lattes, and put your money into complex alternative investments managed by elite Wall Street institutions. I bought into that nonsense, invested in a sketchy yield fund, and watched them freeze redemptions when things went south. I could get my own cash out to pay for a broken car transmission. I had to drive a beat-up 2006 Honda Civic with a grinding gear for a whole year. And I couldn't even afford to buy a proper couch for my apartment. I slept and ate on a literal lawn chair in my living room for 12 months. That was my turning point. That was when I realized Wall Street exists to serve Wall Street, not you. I stopped listening to the corporate suits. I liquidated that garbage, and I took control of my own capital. I focused on high-income skills, maximized my savings rate to over 60%, and poured every single dollar into transparent liquid index funds like VU, plus elite dividend growth rocks like SAG, and aggressive growth vehicles like VUG, no hidden models, no locked-out redemptions, no corporate lies. Today, at 27 years old, my net worth has officially crossed $620,000, and I did it by rejecting the exact same opaque garbage products that the DOJ is investigating right now. This is why a lot of cynical people on Wall Street call private credit mark to myth. Because in public markets, there is at least a real unforgiving price. There is genuine price discovery, and it is completely public price discovery. You may not like the current price of Apple or VO today, but it is right there on your screen, and it is established by what we have good reason to believe is a fair, open market process. I mean, you can say investors are panicking or totally overreacting in a downturn, but the price is the price, and you can see it plainly just like everyone else does. But in the shadowy world of private credit, especially for corporate loans that never trade on any public exchange, the reported value depends entirely on internal mathematical models. Unfounded assumptions, generous peer comparisons, subjective appraisals, opaque internal processes, proprietary black boxes, and in some convenient cases, maybe some compliant third-party valuation firms. During the good times, the bubbly times, nobody cares about the details. If the corporate borrower is paying cash interest every month, if default rates across the industry are low, and if investors are happily receiving their quarterly cash distributions, and if the broader economy behaves somewhat like it might actually be strong and resilient, then everyone is perfectly willing to just go along with the game. But during the painful downside of the economic cycle, those internal valuation assumptions matter a whole lot more, which is exactly why, as I pointed out to you guys last year, the negative macro payroll reports were so incredibly damaging to the financial system. They were deeply damaging to investor trust about these foundational assumptions, especially if a distressed corporate borrower is no longer paying actual cash interest, and instead that interest is being paid in kind, which just means they issue more fake debt to cover the interest payment. Is that troubled loan still magically worth par value at 100 cents on the dollar? If the struggling company has to drastically extend its loan maturities because it cannot refinance in the open market, should the reported value still be anywhere close to 100? If the borrower's core corporate earnings are weakening along with the broader economy, but the private fund confidently says the collateral coverage is still totally fine. How exactly should smart investors trust that subjective mark? And if similar corporate loans in the highly liquid public market are currently trading at much lower distressed valuations, why on earth is the private loan still marked close to full value on the fund's books? These are absolutely not theoretical questions for academic professors any longer. They are urgent, hard-hitting questions now sitting right at the absolute center of the private credit collapse. And the BlackRock DOJ probe is so important because it validates that exact systemic concern. It does not validate the final legal conclusion yet, but it completely validates the deep skepticism. And that core concern is simply this: are private credit funds marking their assets in a way that truly reflects harsh economic reality, or are they marking assets in a deceptive way that intentionally delays the painful recognition of losses? And that, my friends, is the entire financial ballgame right there. And if it was only that, I mean, that would be a massive market-shaking thing anyway. But as I said in the introduction, we have got a whole raft of ugly stories coming in on private credit fast and furious all over again. So we have got the federal DOJ investigating BlackRock. There are growing problems with Apollo and KKR funds that both of those big asset managers are frantically trying to tackle. And again, look closely at those elite names. You have got KKR, you have got Apollo, along with BlackRock. These are definitely not tiny, reckless managers at the fringe edge of the market. These are the absolute core institutional pillars of the global private markets machine. And this is the specific ugly part of the economic cycle where the issue stops being, hey, did a few bad actors make some bad loans? And it suddenly starts to become how much of the entire multi-year boom was built on fake assumptions that only worked while the money was easy and interest rates were at zero. During the peak of the bubble, private credit managers were raising new capital hand over fist. Trillion-dollar pension funds desperately wanted higher returns. Massive insurance companies craved any kind of yield. High net worth wealth managers wanted sexy alternative products to sell to their rich clients. The Japanese banks, the carry traders, and rich individuals all wanted institutional style income. And commercial banks were rapidly pulling back from certain risky lending markets, especially after the terrifying regional banking crisis we saw back in 2023. So private credit stepped right into that void. And so for a brief time there, everything seemed to line up perfectly. But when everyone on Wall Street is trying to deploy too much cheap money into the exact same kinds of corporate loans, you already know exactly where this goes. Underwriting standards inevitably weaken and turn to absolute garbage. That is precisely how credit cycles work. It is not because everyone wakes up one day and consciously decides to be completely reckless. It happens gradually, bit by bit, a little more debt leverage here, a slightly weaker legal covenant package there, a more generous fake EBITDA adjustment to make a company look profitable, an extra maturity extension, perhaps a convenient PIK toggle to avoid immediate default, and a blind belief that the financial exit market will always be there and perfectly dependable. But then the macroeconomic cycle inevitably turns. Suddenly, the hidden problem funds start to show up in the news. The corporate loans that were supposed to be money good are now complicated. To say the very least, corporate borrowers that were supposed to magically grow into their heavy capital structures, make it. The IPO and exit market, everyone was foolishly depending upon just isn't there. And corporate cash flows, cover the rising interest payments the way everyone had beautifully modeled on their Excel spreadsheets. And the elite managers who raised all that easy money during the bubble are now stuck in a room trying to manage the toxic cleanup. And that is what makes the KKR, Apollo, and BlackRock stories so critically important to watch. It is about the biggest names on Wall Street having to deal with the radioactive after effects of their own credit bubble. And if the biggest, most sophisticated names are neck deep in the financial garbage, it is another key piece of undeniable circumstantial evidence of just how much total garbage there must be out there hidden in the shadows. Now, the absolute easiest place for everyday investors to see this disaster unfold is in the BDCs. We have been tracking this on this channel from the very beginning, the business development companies. These are the publicly traded investment vehicles that private credit funds have been using for part of their complex portfolio management structures. And because they are publicly traded on the stock market, it allows us to see a little bit of true market-based price discovery. It is indirect about the underlying private assets, and it reflects public stock investors' realistic perceptions about those assets. But it is at least something real. BDCs can be one of the clearest windows retail investors have into the private credit black box. Because unlike fully private locked-up institutional funds, these BDCs have daily fluctuating share prices and mandatory NAV disclosures and public dividend policies and strict SEC filings. And that transparency makes them incredibly useful for understanding, or at least partly understanding,